What's going on, guys and girls? I hope you are all doing well. I hope you all had a fantastic weekend. First and foremost, thank you all for taking the time, the energy to be present here today, whether you're watching this live, whether you're watching this back on a recording. I always appreciate your presence, your questions, your feedback, anything and everything else in between. I'm with you guys for the next 45 to 60 minutes. We'll see how things get on today. And I want to run you through hopefully another impactful session, something that's you're gonna leave with today with, again, a newfound perspective, a different way to think about your trading, and most importantly, hopefully a new view on how to improve your performance in the markets. That is the essence of everything that we do in these sessions. We have a little bit of a focus specifically on the psychology part of things, but everything is with the aim to improve your performance in the markets. Now, if you're familiar with any of these sessions that I've hosted in the past, I believe this is our 9th session here together. If you haven't watched any of the previous ones, I would highly recommend going checking out the recordings. We have built a little bit of a foundation here as to developing your mindset to work and thrive inside of a probabilistic environment. Today's session is going to be no different. It's going to build yet another layer on top of that. And aimed at actually tackling a really, really important part of what I think what is needed to be a consistently profitable trader. Now, to kind of explain or introduce the topic of what we're going to be focusing on today, I want to take you back to something that I talk about quite often. And again, if you've watched previous sessions of mine, this is something that you would have heard me say, if not once, probably multiple times on a variety of different sessions. And that is this idea that trading is not a job, right? Trading is not a job. The problem is most people struggle with it because they try and treat it like a job. They treat it with the same perspective that they do their typical 9-to-5, their business, and they believe that the more time that they invest into this job, the more that they will get out. And to a certain extent, that is true. You need to dedicate some time, some hours, some energy in order to get anything back from this. But ultimately, when you really unpack how successful traders are paid consistently over time, and when I say consistently, I don't mean daily, weekly, monthly. We all suffer through periods of drawdown inevitably. But when I say consistently, I'm talking about the grand scheme of time in this game in terms of your career. You have to understand that trading is actually much closer to a performance sport, right? You are paid to perform. You're not paid to exchange time. You could sit at the charts from 9 a.m. to 5 p.m., much like you would in any other normal job, but you're not guaranteed to make money. And if anything, especially in this industry, there is a possibility that not only will you be wrong and have a terrible day at work, but it could cost you money in order to do so. All of these things packaged together is a part of what makes trading so infinitely difficult for most human beings. Now, in the last 5, 10, 15 years, trading has become far more accessible. The barrier to entry to actually get in and attempt to be a trader has become far lower. And it's introduced a wave of retail traders that typically come from usually the 9-to-5 space that are trying to create a new life for themselves, a secondary source of income, a new career, a new path, something that unlocks a little bit of freedom that they are hoping and looking for. But with that, they bring with them a mindset that doesn't really allow them to thrive. And largely it's because of exactly what we've just discussed here. Most people look at this kind of industry like a job, and in reality, it doesn't really work that way. Now, if that makes sense to you, if you can resonate, if you agree with that point, then I would say, if you think of trading like a performance sport, the one thing that you should be focusing on each and every day is, how do I optimize my mind, my behavior, my actions, my habits, my routines to work at the best of my ability? How do I work at my peak performance in the markets? Because that's the only way I'm going to be rewarded. I'm sure there are many of you that are watching today's call, again, whether it's live, whether it's on the recording in and of itself. I'm sure there are many of you that have made a great call in the market. You've done all the analysis. You've made this prediction that, stock price this, or this crypto coin, or, this commodity, or this Forex pair is going to go from here to here this week. And it does exactly that. But unless you pull the trigger unless you execute, unless you put some risk and manage that risk and do everything in alignment with your plan, all that analysis means absolutely nothing, right? So everything in the way that you're approaching this industry has to be centered around the idea of performing at your absolute best. And today's topic, I think, is a big part of what impacts your performance over time. And that is your level of confidence in this game, right? There are many of you that would have spent time in this game that still struggle with this aspect of their approach. Sometimes maybe you get too confident, or sometimes you lack too much confidence. Maybe if you're new into your journey, maybe if you're still trying to find your feet, maybe if you're still trying to refine your edge, maybe confidence is something that you don't yet have, and it's something that needs to be built on. It needs to be improved. And this is something that you want to prioritize wherever you are in your journey. This is something that has to be prioritized because of the huge impact that it will have on your performance. As we've already established, analysis means nothing if you lack the ability to actually be able to execute and stick by the things that you are doing. Whether that means you're hesitating to pull the trigger, whether you're getting out of positions early, whether you're not position sizing correctly, because of either too much or too little confidence. These are all things that overall impact your return at the end of the day. And therefore, they are something that should be given time, energy, and resources to be worked on and improved the way that they need to. Now, at its core, we all know what confidence is, right? Confidence is not inherent to trading. It's something that we have with us in many different areas of life. Most of us understand it is this inherent belief in our ability to maybe handle challenges. Maybe it's our belief in taking action in doing something. Maybe it's our belief in our ability to be able to adapt to certain situations regardless of external influences or outcomes, right? We all know what confidence is. We all use this and carry it in many different ways in various aspects of our life. But this is something, as we've already discussed, that also applies to us in trading, right? Not necessarily in exactly the same way, but it definitely plays a role in what we're doing, right? As part of what we do, confidence is a little bit more nuanced as a trader. It's not necessarily about thinking every trade is going to be that big, huge winner that you're thinking about. I think that could, kind of borderline the category of arrogance or maybe overconfidence, which is not always a beneficial emotion or thought process to be going down. For me, when I'm talking about confidence in trading, I would say it's more so about trusting your process and having the discipline to do the things that you said you are going to do in the long run, because that's what consistency really is, right? I am yet to meet a trader that has been able to produce long-term consistent results without having a consistent approach. If you're someone that's constantly changing your strategy, if you're someone that's constantly tweaking and refining things and you're doing things differently every single time you approach the markets, it's very, very unlikely that you're going to have the consistency that you're looking for. And therefore, having that confidence, that trust, that discipline, that willpower to stick to your plan, however you want to frame it, it's a really, really important part of everything that you do. Okay. What's up? Good afternoon, good evening to everybody in the chat. Thank you all for being here. Again, this session is going to be open and interactive. So if there is anything that I explain throughout the session, if there are things that you guys would like me to repeat, please feel free to get active in the chat. I am actively keeping an eye on this. So if there's anything you want to fire my way, please feel free to do so. Towards the end of the session, as usual, I will open things up for a little bit of Q&A as well. So if you guys do have any questions, it doesn't even have to be related to the topic that we're focusing on today. But if you have any questions related to performance and specifically psychology in general, I'm more than happy to take some questions towards the end as well. Right. So back to where we were on confidence, right? If we all agree, and again, I'm hoping this is going to be the case for everyone tuning in, I'm hoping we can agree that confidence is a massive part, a massive factor that determines the quality of our results over the grand scheme of time in terms of our career as a trader. Now, where most people start to go wrong with confidence to begin with is, I think not enough people have actually laid the correct foundation. right? The correct foundation to actually say, you know what, I've seen enough, I've experienced enough, I know enough to actually trust that my plan is going to work over time. And that's an inherent flaw, right? That's something that has to be addressed long before you click buy or sell. You see, what happens to most people is they do not have this correct foundation. They get into the market anyway, and then they panic because they can't stick to what they're doing, or their thoughts and their emotions are going crazy, and ultimately it takes them away from the things that they are supposed to be doing. Now, the perspective that I like to share with most people as to what I think is most beneficial in terms of you keeping in mind to be able to develop that consistent approach is to understand that confidence is not something that you have, right? It's not like the color of your hair, if you have hair, or the color of your eyes that, you know, are kind of fixed traits that you're born with. It's something that's malleable. It's something that can change, and it's something that does change over time. So I always like to say confidence is not something that you have. Confidence is something that you do. And just simply reframing it in that way opens your mind up to this avenue of understanding that confidence can and will change. Confidence is something that I have some level of control over, and it's something that I should be working on creating from the beginning, as well as managing throughout the life cycle of my trading, right? I think the best way to think about confidence is more so like a muscle than a personality or a characteristic trait that somebody is born with, right? I choose to believe that nobody is born confident, right? Nobody is born patient. Nobody is born angry. Nobody is born depressed. I believe these are all things which are inherently learned at some point in time. I believe as human beings, we are all born with a fairly clean slate. We come into this world knowing nothing, and we absorb a whole bunch of things, whether it's in childhood or growing up, that make us the person that we are today. And I like that perspective because it means we get to decide whoever we want to be. It means we get to decide that even though I'm not the type of person today that gets the outcomes or the results that I am looking for, it doesn't mean I can't be that person, right? Everybody successful that you look up to, whether it's traders, celebrities, entrepreneurs, business owners, parents, siblings, colleagues, whatever it is, right? Everybody that you look up to or aspire to in some way, shape, or form, they're just human beings. They have the same 24 hours in a day that you do. We all have access to essentially the same level of resources to a certain degree. What is different is primarily about how we spend our time, what we use our energy on. And so going back to the point of confidence here, if you think of confidence like a muscle, something that can be worked on, something that can be improved over time, then you have to understand that regardless of what position you are in today, you have the complete capability to be able to change it. But everything that requires you to actually be able to make that change starts with one simple thing. And that thing is a choice. You have to decide that you're going to spend your time, your energy, and your resources differently to actively work on this area so that you start creating different results, right? Confidence, much like a muscle, can be built up, just like we're discussing. But also, if it's not really worked on, if it's not refined, if you're not mindful about this area, especially when it comes to trading, it can be something that gets worn away. Much like if you were somebody that worked out and you stopped going to the gym, you'd probably get weaker over time. Muscles will deplete if they are not used. And this is why we put so much emphasis, and most of us understand on a logical or rational level, that if I want to maintain and build and grow muscle mass, I must train it. Confidence is exactly the same way. Okay. Now, specifically for the remainder of today, I want to talk about how confidence relates to your trading with regard to how you build it in terms of a very process-orientated way. And then secondly, how you actually manage it. Because I think confidence is really this two-phased approach. You have to have it to begin with. You have to have built it before you actually step foot in the markets. But then secondly, you actually have to have a plan on how you're going to manage it. Because confidence is not something that builds up and then just stays there forever. Again, it works far more like a muscle than most of us actually comprehend. Now, let's start with the very basics. How do we actually build the right level of confidence? I'm not talking about overconfident. I'm not talking about too little confidence. I'm talking about how do we build the right amount that will actually allow us to start executing and putting money on the line behind some of these decisions, behind our analysis, behind these predictions or forecasts that we are essentially making on a day-to-day basis. Well, I would ask, how do you build any skill, right? Again, when you came into this world, you didn't have an ability to drive. I presume most of you or all of you on today's session will have some understanding of how to do that. You didn't have an ability of how to ride a bike, whether that's a bicycle, a motorbike, a scooter, whatever it is, right? We didn't have an ability to do that when we were born. Some of us didn't know how to paint. Some of us still don't know how to paint. We didn't know how to be good at our current line of work, whether that's your job, your business. We weren't born with these traits, right? Some of us have improved our ability to be good at sales. Some of us have improved our ability to be great at marketing. But these aren't things that we were born with. We learn these over time. So my question is, how did we develop confidence in that area? Think of any area of life that you feel competent in. That if I asked you to speak on this subject for the next 5 minutes, you could do so fairly confidently, because everyone has one. It could be something as important as your work, your family, your business, your job, your source of income, whatever it is. Or it could be something as kind of vocational as what you do for fun, games that you play, sports that you play. We all have an area in which we feel a certain level of competence and confidence and would have no issues talking about it, doing the thing, teaching others about it, because that is who we are as people. Everyone has this area. Whether you think you do or not, there is always something for everyone. Now, my philosophy, again, sticking with this idea that confidence is like a muscle, I choose to believe that confidence comes from experience, right? And I think the perfect analogy for this is really driving. If you're someone that drives, you'll resonate with this. The first time you ever got into a car, it was probably somewhat intimidating, right? I don't know where you guys are tuning in from around the world, but in the UK, it's, I would say, somewhat normal to pass your test on a manual license. At least that was what I was encouraged to do. I understand in other parts of the world, I'm thinking maybe here, primarily America, that's a lot rarer, right? Getting into a car and having to do more than just steer and kind of accelerate and brake and actually have to worry about this clutch and what kind of gear you're in, it all feels very, very intimidating to begin with. It's a lot, right? A lot of people don't comprehend kind of what goes into making sure everything is in the right place so that your car can continue moving in how you expect it to over time, right? But after a period of time, once you get a grasp around, okay, I need to put the clutch down, I need to go in this gear, I need to change this, I need to do X, Y, and Z, at some point in time, it all becomes second nature. And what changes, right? You don't just wake up and suddenly you're fully capable of driving. The thing for me that changes is your level of experience. The more you do it, the more capable you get. And the more capable you are, the better the experiences that you have, and therefore the more your confidence grows over time. And I would argue that actually your trading is exactly the same way. I have lost count of the amount of traders that I have connected with that all struggle with hesitation, closing trades early, not position sizing correctly, a variety of different issues. And the first thing that I usually ask them is to make sure that they have full confidence that they have an edge in the market. And the question I always ask, and this is usually on day one of when I do one-to-one coaching with anybody, is how do you know you have an edge, right? How do you know you have an edge? Take a moment to actually think about that for yourself, right? I'm going to go silent for like 10 seconds, but I want you to think about that for a second. If I asked each of you today, anybody, whether you're tuning in live, whether you're watching this on a recording, I want you to think about for a second. If I asked you, how do you know you have an edge in the market? What comes to mind? How would you answer that question? Now, if you're struggling with this, if you turn around and you say, well, actually, I don't know, that's a red flag, right? That's a red flag. That for me says, you know what, you're probably not ready to be in a position where you even have live funds behind what you are doing. Whether you're trading live capital, whether you're trading simulated capital in some way, shape, or form, you probably shouldn't yet be in the markets. It's a harsh truth, but I think some of you need to hear it, right? The age-old question, how do you know you have an edge in the market? The real answer that I'm looking for in this situation is for somebody to turn around and say, well, I know because I have all of this data. I've done all of this testing for my strategy, which shows me that if I get into the market following this criteria, and if I manage my position based on this criteria, and if I exit, whether it's for profit or for loss based on this criteria, then over a large sample size of both trades and time, my strategy shows that it is likely to yield a profitable return over time, right? So that's really what I want to hear, because ultimately our thoughts and our emotions can all be skewed over time. And I'm going to explain exactly why they get skewed so easily, but they can and will be skewed over time. But the thing that remains, or the thing that has to be, I would say, objective, is your confidence in your ability to stick to your plan because you trust so unequivocally that your plan will make money in the long run, right? I talk very openly about the strategy that I use when trading my personal account. And I wouldn't say I have the best strategy in the world. I wouldn't say I've developed the best read on the markets. But from what my data tells me, a normal period of drawdown is typically anywhere from 1 to 3 months, right? 1 to 3 months of not making money, right? For a lot of people, that would destroy them. And I'm not going to sit here and tell you it's easy, because it's not. But the one thing that makes it infinitely more difficult is knowing that I have data that shows me that as long as I stick to my plan, at every point in time over the last, I've done about 10 years or so worth of testing this sort of criteria. As long as I stick to this criteria, I will endure periods of time where I'm not in sync with the market and I'm not making any money and I'm going through a period of drawdown, but it will recover because market conditions will change and my edge will start to work a lot better in the new conditions going forward, right? Without that data, without that exposure, I would struggle. Can you imagine losing money for 3 months in a row? If you do not have the expectations or the trust or the confidence to understand that this is something that's going to work in the long run, if you had never seen that happen as part of your testing, it's so easy to feel like it's personal. The losses are personal. Your strategy is broken. Something is wrong, and you need to do something differently going forward. In reality, it's a game of probabilities, right? There's a beautiful quote that I always relay back to people. I wish I invented it, but I didn't. It's a quote by the infamous Mark Douglas, right? Many of you will know him from Trading in the Zone, the Bible of trading psychology. He has this really, really powerful quote that he mentions in the book. And he says, there is a random distribution between winners and losers for any given set of variables that go on to define an edge, right? Let me say that one more time. There is a random distribution between winners and losers for any given set of variables that go on to define an edge. And this is, in a nutshell, exactly why periods of drawdown will happen. And this ties into exactly what we are talking about here, because if you do not have the right level of confidence from the very beginning, then that random distribution of wins or losses will completely get to your head. Every winning streak will feel like you invented the markets. You will feel like you invented euro dollar, right? It makes you feel that invincible. And every losing streak will absolutely destroy you. It will make you feel like your strategy is broken and something needs to change going forward. When in reality, things are just working in a probabilistic manner over time. But without data, without the right expectations, it's hard to fully accept that that dynamic actually exists, and therefore it's far more likely that you're going to be inconsistent with your approach. So for me, the key to building that foundational level of confidence really comes from two things: collecting ample amounts of data. And I always get people that press me for this idea of how much is enough, right? Is 10 trades, 30 trades, 50 trades enough? I always like to say there is no black and white magical number where, if you were to do 100 examples, everything just clicks, at least from a psychological perspective, and it gives you the confidence that you need. But everyone does have a threshold. The only advice that I normally give is to start thinking in hundreds rather than ones. If you've got a sample size of 10, I would say that's definitely not enough. I would say if you've got 100 examples, maybe you're starting to scratch the surface. Shoot for 250, shoot for 500, shoot for 1,000. The bigger the sample size you have, it's not going to do you any harm, right? So start collecting ample amounts of data to prove that your strategy actually works over time. Now, this is obviously far easier if you have a mechanical approach. These are things that in this day and age, they can be, I was going to use that word loosely. It's possible to code them. It's possible to use platforms, pieces of software, things like FX Replay, even TradingView. I believe even the likes of like TradeZeller has like backtesting functionality in there, built into their pieces of software. So you can actually go through and test over time that your strategy actually works, right? But you want to build that big sample of data and you want to actually test it and see it work. And I would actually argue that more importantly, you want to see it fail. You want to see your strategy fail. I would argue that it's a red flag if you test a strategy and you've done it over a large sample size and you have 100% win rate. I'm over a decade into this game, right? Still got many more room to learn and grow, but I have never, ever, ever seen anyone that has 100% win rate over a large enough sample size of time. Over a day, over a week, maybe over a month, sure. But over a consistent period of a large sample size of time, I've never seen it possible. Never seen it possible. And this is why this game is not really about certainty. It's always a game of just learning how to manage risk in the best way, shape, or form. Okay? So building that confidence to begin with has to come from backtesting. It has to come from data collection. Now, again, I think I mentioned this is far easier if you have a mechanical approach. It's easy to backtest. I would argue that a discretionary approach is far more difficult to backtest because it's hard to objectively say that my gut feeling based on how I feel today would have been the exact same as 6 months ago. It's unlikely. And so I would say if you have a somewhat discretionary plan that you believe has an edge in the market, your best way to build confidence is actually by forward testing it. But this can be done in a demo environment. It doesn't have to actually cost you any money. But knowing that your judgment, your gut, whatever it is in that moment that aids you to make decisions actually works over time, it should be supported by data. The more you lack that data, the easier it's going to be talked out of decisions, whether it's in terms of your thought process, your emotions that are influencing you, but ultimately it's going to get you to have that inconsistent approach over time. Okay. A few questions in the chat. Mandavia, hoping I'm pronouncing that correctly. I've been in the markets for 5 years, became profitable with a negative risk to reward strategy. I have a good win rate, but I'm finding it difficult in controlling the downside, like I'm holding on to losers more. I need to fix this alone. Can you give me a new perspective on how to control the downside? How can we build mechanical systems in dynamic markets? I try to do so and fail every time in the live markets as market cycles change. Okay, there's two aspects to the questions that you've asked here. The one about controlling the downside, if you don't mind, I'm going to come back to that towards the end of the session because it's a little bit of a different topic of what we're talking about specifically here. Absolutely nothing wrong with that, but I want to keep things slightly on topic for at least the duration of this presentation. The second part I want to touch on a little bit here. How can we build a mechanical system in a dynamic environment? I try to do so and fail every time in the live markets as market cycles changes. Now, I completely get where you're coming from. I completely understand what you're saying. Every moment in the market is unique. The participants that are behind the movements in the market are always going to be different. And therefore, how can a mechanical system actually work the exact same way, right? I would say what you have to understand here is that a mechanical system can work over time. And I'm not talking 100% mechanical. There are a lot of traders that I know that if you have a purely mechanical system, I would argue the best thing you should do is to probably code it. And you could test that over a large sample size of time. And that could be something that you run in the market. It's the most efficient way to have a consistent approach in the market. But for a lot of people that have a little bit of a hybrid, there's a lot of people that think they have a purely mechanical system, but there is a level of discretion that actually exists in there. They can work over time, but what you have to understand is they won't work all the time, right? A profitable strategy can be profitable even if it doesn't work all of the time. And this is why drawdown will always exist, right? Every strategy has a period or a condition in which it works, and it will have conditions in which it fails. If you had a strategy that worked absolutely fantastically in a range-bound market, it's likely to get chopped up when markets are moving parabolically in one direction, right? If you have a strategy that thrives on trending markets, well, when a market is range-bound or transitioning from a trending market to a range-bound market, you're likely to get chopped up in those conditions. So it's about understanding that every strategy can work. They're just not going to work all the time. And this is part of the uncertainty of the market. So I would argue that if you've tried and failed with this kind of approach at building a mechanical system, ensure you're doing it over a large enough sample size of time, because there are patterns in the market in terms of, I mean, that is exactly why technical analysis exists in some way, shape, or form. This is why we will see chart patterns fail and work in some occasions, right? They do exist to a certain extent, but you have to understand they're not going to work all of the time. So the only way to rule out whether something does truly work over time is to really test it over a large enough sample size to deem whether you've experienced enough market conditions that it actually has an edge over time, right? That would be at least my perspective on it. I hope that helps. Hope that gives you some perspective of that. Paolo says, to have a mechanical system in a market that has cycles, your system must constantly self-adjust to what the market is giving you. And there are many people that do this, right? There are many people that have an approach that is firstly determined based on the profile of the market, the conditions of the market they are working within. What type of characteristics is this market presenting? And therefore, based on those characteristics, what mechanical rules or strategies or criteria am I going to implement that work well as part of this condition, right? Again, a strictly mechanical system will say, these are the criteria that I am going to use all of the time. And then you have ones which are going to be market condition dependent. So they will adjust depending on a trending or a range-bound market, or, you know, various different characteristics or, you know, things that you can identify somewhat objectively to give you an idea of what that looks like. Okay. Now, that was I guess an introduction as to how you actually build confidence from the ground up. Everything in the way that I approach trading, everything in the way that I approach psychology and optimizing your performance is always centered around this. You would have heard me say this on many different occasions if you've tuned into any of my sessions before. I have a big emphasis on data, on back testing, and I think they truly form the foundation of everything that you need going forward. Now, if you've got to that stage where, let's say, you've been through 5 years, 10 years worth of data, and you've got a strategy or an approach that has shown to give you an edge in the market, right? What would you say is the next thing that you should be focusing on from a confidence perspective? I would say, for me, logically, the thing that you need to be able to understand most is, how do you maintain confidence at the right amount? Because confidence, like I said, it's like a muscle. It's not something fixed. It will change over time, as it does in many different areas of life, right? You could be a very competent driver, but God forbid, if any of you got into an accident, it's very likely that the next time you get behind the wheel, you're going to feel a little bit hesitant. You're going to be overly cautious. You're going to look left and right 4 times instead of the usual once or twice that you used to. It's just natural. It's part of human psychology, right? The same is true in, let's say, relationships. If you were in a relationship with a partner and your partner cheated on you, it's very likely that the next relationship you get into, it would be somewhat normal to have some kind of trust issues, right? You would be a little bit more cautious, weary. You would have your guard up. Your confidence has been knocked. This is a part of human psychology. Now, trading is no different, right? Confidence is not something that you get to the right amount and then it just maintains static at that point. I would argue that actually confidence in trading is something that you have to be very, very self-aware about, because it is very much likely to change over the course of time, right? We have two kind of, think of confidence kind of like a swinging pendulum, right? Right in the middle, you have the perfect amount of confidence where you're confident enough to get into the market, but not so confident that you're going to bet your entire account on the next position. And on one side, you have overconfidence, right? Overconfidence is where you fall into that kind of realm where you're at risk of maybe overtrading, right? Overtrading, and I always like to clarify this, overtrading is not a specific number of trades, right? Person A and person B could both take 10 trades in a day. One of them could be overtrading. One of them could be completely sticking to their plan, right? Overtrading is simply an indication that you have traded more times than your edge has presented. So if somebody or anybody ever tells you that, hey, you've taken 3 trades today, you look like you're overtrading, you need to step away, but you have been following your plan, that's not overtrading, okay? That's not a sign necessarily of overconfidence. If your strategy is telling you that you should be in the market, you should be pulling the trigger, right? At least from a somewhat mechanical perspective. There are nuances in where I would say, yes, it makes sense to step back, but overtrading is not always directly linked to, being automatically being overconfident in this game. I would say the large one that more people need to be aware of when it comes to being overconfident is actually ignoring your risk, right? It's risking maybe too much on a particular setup, and this is often the case after a few winners. Or maybe we just get a little bit loose with the criteria that we're looking to trade, and we start getting a little bit more heavy behind the position sizes that we're putting on because we've had that good streak in the markets, right? That's standard signs of being overconfident, not sticking to your plan, not adhering to the risk management guidelines and protocols that you have specifically put in place, right? The other side to this is lacking confidence. And again, I'm sure we've all experienced that at some point in time as well, whether that's missed opportunities, maybe hesitating when you should be pulling the trigger, or maybe it's a lack of conviction behind the trades that you're actually taking. Maybe a trade is going in your favor, but your mind is just telling you that, hey, I need to lock in these profits because I'm not super confident that it's going to reach my desired target. And again, there are nuances where it makes sense to actually close trades early. But in the large kind of the broad and general term of what we're talking about today, you want to be sticking with your plan at least the vast majority of the time. And so confidence always has to be monitored, right? It's going to swing at certain points because of the external variables which we can't control, the losing streaks, the winning streaks. And it's going to swing between the right level, between overconfident and lacking confidence at points in time. Your job is not to eliminate any one of these things, because overconfidence and lacking confidence are not bad things, but they are bad when they start impacting your performance. Your job is to become aware of what you're experiencing and then manage everything in between to ensure that you're approaching the markets with the right level of confidence. I like to call this equilibrium, right? A balanced state where you're not too heavily swayed from one side or the other. You can look at things fairly objectively, and you're not going to be tied too much in a particular bias or an idea because of maybe recent experiences. Now, why does this tend to happen? Why do we get trapped in these cycles of feeling too much confidence or maybe too little confidence at certain periods of time? When you unpack the psychology behind this is actually a very, very normal thing, right? I would say that there are 2 aspects to our psychology that you really want to be aware of, which I think play a huge role in how much or how little confidence we have at any one point in time. The big one that I talk about very, very often is recency bias, right? Recency bias is the natural human tendency for us to put more weight on recent events rather than what is likely to occur over time. This is one of the big reasons why we get carried away when we've had a few winners, or we start doubting our strategy once we've had a few losers. Our mind inherently fixates on the most recent events, and it forgets what has happened in our testing. It forgets what is likely to have occurred over a larger sample size of time. And that's, again, something that you really want to be aware of. It's not something that you can inherently stop or turn off. You just have to be mindful that this dynamic actually exists. Your mind will naturally put more emphasis on recent experiences as opposed to what happens over a larger sample size of time. The second one that I would add on to this is what we like to call confirmation bias, right? Confirmation bias is where your mind purely fixates on pieces of data, bits of information, or certain perspectives or narratives that already fit the existing bias that you have in your mind. And I've definitely been guilty of falling into this trap before, where you come into trading one day, you open up your charts, and you have a pre-existing bias in the markets. You're overwhelmingly bullish or bearish for any one particular reason. And at some point in time, you will only start focusing on bits of information that support that existing narrative. So let's say, for example, I was bullish on a particular market, but from the open that day, the market just fell and fell and fell. It becomes so easy to fall into this trap of believing that, you can find a reason to buy this market. You draw up a trend line, or you throw up some kind of indicator, or you draw up a line of support and resistance, or you'd be identifying every demand zone in order to justify a reason to be long that market. And it takes for the day to end, usually the market to, really spank you that day, which is generally what happens when you have a fixed bias and the market is not working in alignment with it. You tend to find that at the end of that day, it looks so obvious. You look back at the exact same chart and it was so obviously a short. If I just had the ability to change my bias or see the other side to this, I could have easily found an entry to got in short and made some money from today, instead of getting, I was going to go down a route which I probably don't want to say on here, but getting absolutely spanked by the market, right? Again, we've all been there at some point in time. But these two largely together, I think, make up a big chunk of the reason as to why our confidence tends to swing one way or the other. We all suffer from recency bias. We all suffer from confirmation bias. And these together at work in the markets, when you have money on the line, it all becomes very, very easy to get caught up in a certain way, shape, or form. And that's going to skew keeping that balanced perspective of the market, right? Specifically, and lastly, I just want to mention on that kind of confirmation bias, it becomes so easy to fall into that trap of, like, when you're feeling confident, you will find every single bit of criteria, every bit of analysis that worked out to tell yourself, I knew it. I knew I should have just jumped into the market. I knew the market was going up. This is where it starts to get dangerous. And similar to the downside, right? You try and be disciplined. You try and do all the right things. You get into the market when you're supposed to. And, you might have had 3 losses before this, but suddenly the trade doesn't work out. And you tell yourself, of course it didn't work. Why would it work? I'm always wrong in the market. Look at my past performance over the last 2 weeks. I've had a terrible, performance. You start telling yourself those narratives. That is your mind looking for pieces of information to support the pre-existing narrative in your mind. It doesn't just have to be market bias. It could be the beliefs about yourself, about you, maybe an inflated self-belief about your ability to perform, or maybe you're underperforming. Maybe you're not believing in yourself enough, and you're ignoring what happens over a larger sample size of time. But both of these together can really be a recipe of disaster if you're not aware of them. Okay. Now, how do we actually start to manage these things over time? What can we actually start doing to make sure that we're not getting overconfident and we're not lacking confidence over time as well? Well, first and foremost, and again, if you're familiar with my sessions that I've hosted previously, one of the things that I always start with is you have to be able to raise your level of self-awareness. It is no use being able to recognize, oh, I suffered from recency bias and this is why I screwed up my last trade. There's no point in doing it in hindsight. You're not going to improve your performance if the only thing you are able to do is recognize your mistakes in the past. For me, improving your level of self-awareness is being able to better be in tune with what is going on in the present moment, right? Online, I go by trading in the now. It became my online handle many, many years ago. And a big part of that was credited to this idea of my biggest level of improvement as a trader came from my ability to be present. It came from my ability to live in the now moment and see the markets for what they are and not what I wished they could be. And a big part that makes me consistent, not all of the time, because obviously I'm not a perfect individual and I don't think one actually exists. But what makes me consistent the majority of the time is that I have developed a very heightened level of self-awareness that gets me to very quickly recognize when my mental state is not primed in a way that's going to help me to thrive in a probabilistic environment. So when I've got a thought or an emotion which is not really going to serve me well, this is going to be something that I'm very, very mindful of. And I start doing certain things proactively and reactively to make sure that they don't run, they don't get completely carried away and it turns into a full period of me acting on tilt. And in all honesty, this was something that I have been actively doing this morning, right? I'll give an example as to specifically what I'm doing here or have done this morning after I finish this section, because I think it will give you some practical ways in which you can start to approach this, okay? But raising your level of self-awareness, I would say really comes from two aspects. The first one I always recommend is some form of mindfulness practice. I always advocate for meditation, and that can be from a very, very small daily practice, which I've been doing for a number of years now, and I found that it's drastically improved my ability to be present, right? It's drastically improved my ability to recognize my thoughts and emotions in real time before they necessarily become actions. Now, when you combine that with a good detailed journal, now you have a recipe for success, because your journal, if you're documenting all the right things, should start to connect the dots between your thoughts, your emotions, and your actions, right? It starts to show you the pattern of behavior in everything that makes up your actions on a day-to-day basis. Because I believe nothing happens by mistake. I believe if you are overtrading, if you're revenge trading, all of that stuff hasn't come from nowhere. We all tend to operate in certain patterns, certain cycles, and the better you can get at identifying those patterns and recognizing them in combination with this mindfulness practice, the more likely you are to be able to actually do something different, to break free after a period of time. And that's where you really start getting your breakthroughs from a psychological perspective, right? I always like to say good trading is not the absence of emotion, it's the regulation of them. And that's something that I have found has drastically improved my journey. The moment that I stopped trying to fight emotions, and the moment I just submitted to the idea that I am going to feel certain things, but I have complete control over how I choose to react to those emotions, that's where I found I was able to be far more consistent going forward. Okay. So the foundation always starts there. For any problem that we discuss, I would say 95% of the time, I'm always going to recommend starting there. You need to become more mindful to recognize the problem in the moment. Hindsight is not good enough. And then combine that with understanding your patterns of behavior. What are your triggers? What brings on revenge trading? What brings on over trading? What brings on arrogance, overconfidence in the market? Once you start understanding what those boundaries and thresholds are for you, then it becomes far, far easier to understand how to proactively get yourself ready to experience all of these things. For me personally, for example, if the moment I start experiencing 4 or 5 losing trades in a row, my mind has a pattern to start feeling a lack of confidence, right? I have a specific protocol in mind. The moment I start getting to like 3 losers in a row, I start telling myself, okay, I need to start switching to this kind of drawdown protocol, to this lack of confidence protocol, to bring that level of confidence back up to ensure that I am managing my confidence in the right way, right? And I do this by changing my exposure. And this is part 2 of being able to manage your confidence. Part 1 is, yes, you have to raise that level of self-awareness. Part 2 is, once you have the awareness to understand what you're about to experience, you need to change your exposure accordingly, right? Now, this is where I say understanding a little bit of human psychology can be very, very beneficial to your journey, right? Many of us will not really understand why we go through these pendulum swings of overconfidence, lacking confidence, sometimes at equilibrium. But the moment you understand that the human mind suffers from recency bias, and it is a normal thing for us to prioritize recent events as opposed to what happens over time, it makes sense as to why a few winners make you feel really, really good, and a few losers make you feel like your strategy is completely broken. So I would say now that you understand recency bias exists, now that you understand the human mind prioritizes things that you have experienced in the short term, you can then start to leverage recency bias to start working for you rather than having it work against you. Now, what I mean by that is if you have identified, let's use my recent example of after 4 or 5 losing trades, I start to feel maybe a lack of confidence. I start doubting my strategy to a certain degree. I have a certain protocol now whereby my 3rd losing trade in a row, I want to be aware of the fact that if I was to take another 1 or 2 losses, I'm likely to start doubting my strategy. I'm likely to start looking like, at somebody else's trading, for example, and this was a big pattern that I fell into a lot of the time in my early days. I would start thinking the grass is greener. Somebody else knows something that I don't, and therefore I need to learn their strategy and abandon the one that I have because it just doesn't work anymore, right? Now, so my protocol is at that point in time, I need to expose my mind to bits of information, my back testing, my data collection that supports the idea that my setup will work as long as I trust my strategy over time, right? I can look at all my bits of information and I can say that, okay, I've actually experienced I'm getting, starting to doubt my strategy and I've taken 5 losses, but my data shows me that, 17 months ago, I actually took 7 losses in a row. But what happened after that by being consistent with my back testing is I actually overcame that. Market conditions changed and I bounced back and I made all my losses back and then some, but it just required me to be consistent. And you could do the exact same on the other side, right? So when you're feeling a lack of confidence, you want to look at specific bits of data. You want to look at specific bits of information that give you confidence that your setup works. Whether that's your data, whether that's your back testing, whether it's screenshots of taking the same type of setup you're taking now, if you have maybe a far more technical approach, taking the exact same type of setup and then seeing it work to absolute perfection, right? Just have a collection of those screenshots in a folder. The same can be true for overconfidence. If I have had, let's say 2, 3, 4, 5, 10 winning trades in a row, whatever that cycle is for you, if you start understanding that my pattern of behavior is I start to get overconfident over a period of time, well, then I would say it actually makes sense to leverage recency bias and start reflecting on setups where you've done everything right. You've taken that A+ setup that ticks all of your criteria, but actually it failed miserably. You got stopped out in record time and it just did not work on that occasion. If there was anything that was going to humble you in those moments, it's going to be seeing that A+ setup and watching it fail absolutely miserably. And that's going to be your reminder to say, hey, there is no room to get overconfident. There's no room to think I need to double up my position size for this trade because it just looks so good and I've been in flow with the market recently. Anything can happen at any point in time. If you're going through a good phase, you might be 1 trade away from starting your next period of drawdown. If you're going through a poor phase, you could be 1 trade away from ending that streak and starting your return to a new equity high. That's the nature of the markets. That's the probabilistic game that we play. Whilst we can't control the outcome, we can control what we are thinking and feeling with the extent that we can change our reaction to our emotions, right? So when we start experiencing a lack of confidence, we give ourselves recent bits of information. We're leveraging that recency bias to bring that level of confidence back up. We want to see examples of our setup working. We want to see data that proves that it works over time, right? When you start getting overconfident, you want to reflect on the opposite. You want to start looking over data that shows you that your strategy could go into a period of drawdown at any one point in time. You might have data from, 4 years ago, I went through a 7-trade winning streak onto a 15-trade losing streak. And that was the swing, that it took me through. The only thing that will keep you emotionally stable, to keep you on the best path, the most linear path to having somewhat consistent results in the market, is to just be consistent with your plan. If you don't have the right mindset with the right level of confidence to be consistent in that approach, your strategy will fail over time. Not because it's broken, but because your ability to actually execute it consistently is not going to work in the way that it should, right? So I think this can be a fantastic playbook for you guys to start thinking about, right? Start understanding what are your patterns of behavior. If I don't have the right level of confidence, how do I build that? I would say, in my opinion, put a pause to any live trading for that point in time and firstly lay the right foundation. You have to have the right level of confidence to begin with. Once you have that, what are your patterns of behavior for falling into a spiral of overconfidence? And what are your patterns of behavior that put you in a pattern of lacking confidence, right? Once you understand both of those things, build a process-orientated protocol that uses and leverages recency bias in your favor to start rebalancing that level of confidence in the way that you need it. How are you going to recognize an imbalance in confidence, whether it's over or under confidence, right? How are you going to become aware of that? Is it through your journals? Is it through your mindfulness practice? What are those patterns of behavior for you? Is it just one trade that sends you on full tilt because you've now lost all ability to have confidence and trust in your plan long term? If it is, be ready for that. Have that protocol ready. Be ready with the data, the screenshots, the back testing that shows you your strategy does work if you are consistent with it. Okay, that is a big part of how I would, in a very process-orientated way, get people to start actively managing their confidence over time, right? So some exercises for you guys to take away from today, and then I will jump into the chat and try and catch up on the messages that some of the questions that you guys have been asking. Exercises that I want you guys to take away. I want you guys to ask yourself, what is my current threshold at falling into a state of overconfidence? And what is my current threshold of falling into a state of underconfidence? What is that number for you? Is it 1 trade? Is it 2 trades? Is it 5 trades? Is it 10 trades? It might be different for winners and different for losers. That's part of us being unique individuals. This is part of learning more about yourself. But the more you can have clarity around that question, right? The same way in which I can tell you guys today quite confidently that my pattern of behavior is if I've had 4 or 5 losers in a row, my mind naturally starts to feel that lack of confidence. Even though I know with my current hit rate, I could take double-digit losses in a row. That's a normal losing streak for me, right? It doesn't stop my mind from playing these games. So understanding what that threshold is and being prepared for how to deal with that from a psychological perspective is what helps me to keep a more consistent performance in the long run, right? Secondly, what is going to be your protocol for adjusting your exposure, right? What are you going to be doing? You want to be looking at data? Do you want to be looking at screenshots? How are you going to collect that? Are you going to have them ready? Do you need to have them on your phone if you trade on the go? Like, these are all things that you need to be prepared for in order to be able to manage this as best as you possibly can. And I think the underlying message that I want to share off the back of a session like this is I think that there are a lot of people that put a lot of emphasis on their strategic edge, right? And rightly so, right? If you don't have a strategic edge in the market, if you don't have a list of criteria that gets you in and out of the market and unequivocally shows you over time that it actually gives you a positive edge in the market, you're not going to make any money anyway, right? I could give you the best advice on trading psychology, but if you don't actually have an edge, all I'm going to teach you to do is to be happy losing money slowly over time. That's not the goal either. So as you rightly should, yes, prioritize your strategic edge. But once you are confident that you have an edge in the market, I would argue that you need to start putting time and resources aside to actually prioritizing your mental edge, right? Your mental edge is that ability to be consistent with your plan. confidence, as we've discussed today, is one quite large variable that goes into determining your performance over time. And for me, you have to have the right balance of all of these things. It's if you have the perfect strategic edge, but your mental edge is at an absolute zero, it's likely you're going to mess up the trade anyway. In order to make money consistently from the markets, you need that strategic edge and you need that mental edge in order to be consistent with it. Otherwise, you're just going to end up in a place of frustration and ultimately trading on tilt at some point in time. Okay. I hope that's been insightful for you guys. I hope that's given you something to think about, something to walk away from, something to actually start working on off the back of today's session in and of itself. Okay. Before we wind down today, I know we have a few questions in from the people tuning in on YouTube. I want to try and catch up on a few of these and just give you guys some brief insights and answers from my side. There was one a little bit earlier from Ben. Ben says, what type of stress test do you recommend to be done on a mechanical system to help verify robustness? For example, using Monte Carlo. Monte Carlo, I would always recommend, especially, like I said, if you've got a somewhat mechanical system that you can really test that out over time. I think it can be very, very useful for you. Seeing the number of different potential outcomes from your system over time, I think can be really, really good. My personal preference, I don't get too deep into this, and I would arguably say that I'm probably not the expert in, testing robustness of a strategy, but I'd just like to ensure that I have tested this over a large enough sample size of time. And when I talk about large enough sample size, I'm talking the space of, I'm thinking in kind of years and decades rather than days and weeks, right? I know many traders that make the mistake of testing something over a small enough sample size and think that, hey, just because it's performed really well over the last 6 months, it's going to work well overall. I tell so many traders, pick whatever market you want to trade. Go to a daily chart, zoom out as far as you possibly can, and have a look at the differences in market conditions year on year. Because that's the one thing that's going to change every year. There are going to be different fundamental drivers, political drivers, economical drivers, whatever it is, that's moving a particular market. And they are going to be different each and every year, right? We covered this a little bit earlier today, in which that every moment in the market is ultimately unique, right? People are going to say that, yes, interest rates were cut last time from here to here, and maybe we're going to go through that sort of cycle again. But the participants that are behind that move are going to be different. I want to know that I have tested my strategy over a variety of different market conditions, through black swan events, through recessions, through things like that, to know how they are likely to perform over time. Does it guarantee anything? Of course not, right? Tomorrow could be the start of a new market condition that maybe none of us have ever expected before. I would argue that maybe COVID was something like that. It was a point in time. It was one of those kind of black swan things that we had never really experienced, at least most definitely not in my lifetime. And it created conditions which were very, very different to what I was expecting, or very different to what I had ever seen before, right? Having the market drop as sharply as it did is one thing, but then having it recover in kind of the V-shaped way that it did was another. I think it definitely caught a lot of people off guard, and that was reflected in, I think, a lot of people's performance over the space of that time. So I hope that answers your question, Ben. Again, most definitely, I would say not my strict area of expertise, but that would be my personal approach. Mendavia says, doesn't confidence subtly convert into complacency after a period of time, which decreases the performance and takes a lot of time to rebuild? It most definitely can, right? I don't necessarily disagree with this, because what we're talking about here, I would link more so to the degree of habits, right? When something becomes truly a habit as part of your life, you tend to start operating with that habit on autopilot, right? Much in the way that if I told you all to go and turn on the light in your room, most of you would know how to do that, and you wouldn't have to consciously put any thought into it. You would go over to your light switch, you would click it up and down, and it would work completely as you expected, right? So to a certain degree, yes, having a certain level of confidence and ingraining something as a habit can lead to a certain degree of complacency because of our ability to go into kind of autopilot. But this is why I encourage self-awareness, right? This is why I put so much emphasis on it, not just in this session, but in every other session that we have done before. If you maintain a higher level of self-awareness and you keep a good journal over time, you can start to understand when the cracks start to form. I've always loved the quote, Rome wasn't built in a day, but it also didn't crumble overnight. The same is true of your strategy. I don't believe that one day you're completely process orientated and then the next day you're completely like full scale trading on till absolute gambler. I believe that there are cracks in your process that occur, and your ability to recognize those cracks, whether it's through journaling, whether it's through mindfulness, whether it's through just being on top of your approach in the markets and understanding when you're maybe not sticking to your routines or you haven't done certain things. These are all things which will amplify and accumulate over time that will lead to a full-scale blowout over time. But if you're aware of them, if you maintain that level of self-awareness, then I believe it is something that can be managed over time. Paolo says, I started on Darwinex a short time ago. I'm already positive, but I haven't reached the index above 75 yet. What can you tell me about this? Is it normal? And with a little bit more time, will the index, with a little more time, the index will come, or do I really have to be more patient? If you backtest and you don't trust the results, why backtest? Create a plan and trust it. Be patient. The best is yet to come. The comment on backtesting, I completely agree, right? What if you're not trusting your plan at the end of it? What is the purpose of what you're doing? And I would argue that is the primary purpose of backtesting, right? The purpose of backtesting is not to test emotions. That's a lot of the reason why people exclude it. They say, oh, it doesn't include emotions, so therefore it's pointless. No, the purpose of backtesting is to develop the confidence and trust, and it's actually the most efficient use of your time to understand how your strategy performs over a large sample size. That's what gives you the trust and the confidence that it's actually going to work over time. With regards to your comment on reaching above 75 in the index, yes, I think if you're doing all the right things, if you're maintaining that positive performance, I would say, yes, be a little bit more patient in how you work. This may be something to clarify maybe with the likes of Kieran or somebody else from the Darwinex team to really understand what goes into maintaining that certain rate and getting above a certain threshold. But in my view, from my perspective, as long as you are maintaining that perspective of managing risk over time, yielding that positive result, I think the rewards will start to speak for themselves over time. I obviously don't know much about your Darwin without looking into it and how long you've been at that stage. It's hard to tell, but it's definitely something that can be unpacked, definitely in the Discord for specifics around your Darwin itself. Okay, I think that covers basically everything. If you guys do have any other questions, feel free to bring them along to our next live session. We do these once every couple of weeks, and we'll always do a little bit of open Q&A towards the end. So if you're watching this back on a recording and there was something that you wanted to ask, be sure to bring it across to the live session. Otherwise, you have the option, if you would like me to answer a question live on a call, feel free to reach out to me on Discord. I am part of the Darwinex Discord as well. Shoot me a DM. I can't promise that I will answer straight away, but I will keep it noted. I will bring it across to our live session and I will answer your question. Okay. I hope you guys have had a fantastic session. Thank you all for your time and energy today. Most importantly, I hope it's been something that you've gained some value from today. Yeah, I hope you have a fantastic rest of the week, and I look forward to speaking to you in the next one. Take care, my friends.